What is the driver of mortgage rates? Hi everyone, my name is Mike Rennick. Welcome to another edition of 2 Minutes with Mike. I am your host for this video. My guest today is
Don Bartolomucci.
Bartolomucci. I'm getting closer, and I say that with all due respect. I love having you on these videos. So first of all, let's share. We're doing a series of videos today. We're at Ken Thompson Park. Beautiful day. It's a windy day, but you can see part of the water behind us. This is one of the many reasons I like this part of Florida. But I'm a little confused, Don. I'll be really honest here. I don't fully understand the driver of interest rates, whether they're low, high, or medium. Can you help me?
Well, that's the $10,000 question, but the focus.
That's why I have the expert here.
We'll just make this very, very basic.
That's what I need. Thank you.
The focus right now is on the Fed. The Fed, the Fed, the Fed. How many times have you heard the Fed is raising interest rates? Mm-hmm. Okay, so what the Fed does is they control the rates at which banks borrow money from each other overnight. That's the Fed funds rate.
Would that be called, is that like the discount rate?
It's a discount rate.
Okay.
So that rate indirectly affects the rest of the economy, because as banks have to charge more money for interest rates,
it's like a store. When they have to pay more for supplies, we pay more as consumers.
It's the same.
So banks are paying more for money, correct?
That's right.
Okay.
In conjunction with that, the last 3 years or so, there's also mortgage-backed securities, which are what directly affect our mortgage interest rates. MBSs, mortgage-backed securities. Historically, it's a free market, supply and demand. But the last 3 years, the Fed has been purchasing all the excess mortgage-backed securities that come out for sale, and consequently, if supply is down, what happens? It pushes prices basically up. Interest rates work inversely with prices.
See, so that's where I get confused. So let's cover this slowly.
So if the Fed is buying all these mortgage-backed securities, they're artificially keeping the price of mortgage-backs higher.
It just dawned on me. Go ahead.
So now, because those mortgage-backed securities prices are higher, yields or interest rates are lower.
So it's the inverse relationship.
Exactly. They work inversely with each other. So what's happening now is, while the Fed is raising their Fed funds rate, they're also curtailing the purchasing of mortgage-backed securities. So what's happening to prices? If there's more supply, prices are going down, and what's happened to yields? They're going up.
Yields going up, or the interest rate.
So it's in a nutshell.
And we're in a period where interest rates are rising. They've been, like Don said, artificially low for a long time. This isn't going to go on forever, and there's still good ways to get a deal on a mortgage in terms of interest rates and programs and stuff like that. But what you need, in my opinion, is to talk to a good mortgage person. And the gentleman that I recommend, and he's knowledgeable, he's helped all my clients that are looking to finance properties, is Don. And Don, how would someone reach you?
941-227-7618.
And I'm Mike Rennick. My number is 941-400-8735. Thanks for watching.